Hello and welcome to a brand new show of Market Makers. The big question for 2015 is that at global level, are we on a brink of a recession? What about US economy? Will that be the only source of growth? And when it comes to India, after a great 2014, will 2015 be a year of breakout? How should one read into the latest batch of macro data? And what about crude? Such a chaos in the biggest commodity in the world, can that really lead to a severe and a sharp financial adjustment? To discuss all that and to also identify some money-making ideas, I have with me a very special guest. And I've always maintained Nilesh Shah is one of the best stock pickers on D Street, someone who has identified not one but dozen of multi-baggers. Nilesh, great to have you back. I know you hate me for saying this, but history is on your side. You've been one of the finest stock pickers I've met.
Thank you, Nikunj. Thank you so much for all those kind words. And I think clearly owe this performance or whatever the track record clearly to the entrepreneurs and the managements who run these companies.
And the big picture is that things are not looking all that stable. More than risk on, it is suddenly risk off for global markets.
I tend to I think clearly macros have always been confusing and complex. As somebody said that we live in a VUCA world, a VUCA world, a volatile, uncertain, ambiguous and a complex world. And I think it continues to be the way it is. I don't think the macro environment has changed dramatically post-2008. The good news, I think at least, is that there is a realization that this pumping in of liquidity has really not lifted economic growth. And clearly the fort which has fallen is the commodities. That's clearly been the biggest capitulation, where there was really no strong economic growth to back up the price movements in commodities. And finally, that's given way. And therefore, you see clearly so many commodities, in fact, the entire commodity pack off significantly from their highs a year back or 5 years back. But at the same time, I think this is really a piece of big good news for the world as well. Because clearly commodities was stoking inflation, which was taking away the savings of the consumers. If we need economic growth back, be it India, be it the emerging world, or be it the global economy, we need savings to come back. And I think this fall in commodities is going to bring savings back, which is going to give more money in the hands of the consumers to spend.
Double whammy, so to speak, for us.
Absolutely, because I think on one hand, if you have costs coming down because of crash in commodities, and on the other hand, if you have productivity improvement coming in, and where you have millions and billions of people getting channelized into the mainstream, thanks to what's happening also into the digital world, I think this combination of C and D, commodities, crash of commodities, and development of the digital side, I think creates, in a way, Goldilocks situation for the world economy as well as for India.
Okay. Let me throw in one more letter, which is H, and that's the hope. 2014 was all about hope. Rather than outward looking, Indian investors were inward looking. We got a new leader. That made all the difference. The feel-good factor made a comeback. But earnings have not come back. And some would argue that stock prices have run way ahead of the real economy.
I clearly believe that yes, I think 2014 was the year of hope. I would actually say that you mentioned we've got a new leader. And 2014 to me was the year of induction, the year of intent for the new leader. I think the year 2015 is going to be the year of implementation. That whatever you have envisaged, whatever you have envisioned, whatever you have conceived, it's time to implement in 2015. Such that the year 2016 onwards becomes the years of impact. So I clearly believe that again, from going from the macro to the micro, I think yes, 2014, the earnings delivery has not been there on an aggregate basis. We've got overall earnings grow in single digits. 2015, I believe, will be no different. 2015, again, from an earnings standpoint, will be pretty much similar to 2014. Yeah, but I think from the year 2016 onwards, we could calendar year, okay, which will mean FY17 onwards, you could actually see earnings growth for a wider majority of sectors and a larger number of companies participating in the growth. So you could see most of the companies then getting into a new cusp of a growth cycle. And I think it's pretty much, and there are some similarities here between India and China. I mean, if you flash back to 1980, that's clearly when China had a new leader who really had some grand plans and grand vision for his country. That actually synchronized with the burst of the commodity bubble. So if you flash back, 1980 was when gold, crude, etc. all had peaked out. Yeah, and then of course you had a 20 years of bear market in commodities with lower costs. Okay, this leader of China could really build the infrastructure and the economy of his country, which ensured that China grew at more than 10% for 20 years. I think it's pretty much similar.
That's a big sketch. Let's fill in the colors. And when I say fill in the colors, let's talk about this month, next month, this quarter, next quarter. The month of Feb could be an important month for Indian markets. We have the budget. We would hear on the Finance Commission, from the Finance Commission, and hopefully Reserve Bank of India will also cut rates. So do you think the month of Feb will be the big deciding month for Indian markets?
Well, it is going to be a very, very important month, undoubtedly. And while we may say that you really don't need to pick one date to really announce your grand plans, but the reality is that this budget is going to be very, very important. This has to be a transformational budget. It has to be a budget which really spells out what the government is going to do in terms of implementation. I think everybody really knows what needs to be done. Be it GST, be it infrastructure, be it kickstarting the investment cycle. But I think it's now time to basically really get into the specifics and see really what this budget has. So I clearly think that this is not going to be a budget for the next 1 year. My sense is this will have to be a transformative budget which talks of the next 5 years. It will have to be a 5-year plan.
Talk about the market behavior at a time when we are perhaps talking about the fact that new nation building will start, the broken down capex cycle and the investment cycle will pick up. Why is the market behavior still favoring expensive consumer names? As we speak, HUL, Nestle, Colgate, ITC, all of them are sitting at record highs.
Well, I think the reality is, and I think if we look at the experience of developed markets, finally what the market always and always respects is basically growth, quality of balance sheet, and capital allocation. I think these are the three factors which the market always respects.
It's coming at a price, Nilesh.
It is. And I think the market will always engage in excesses. So while we have excesses on the downside, we will also see excesses on the upside. And I just kind of take this back to the 90s, when in the 90s, when economic growth was anemic, especially that period of 1995 to 2000, those 4 to 5 years when we struggled, we just opened up our markets and we had overcapacity. The economy was not growing very strongly. We had some change of governments and all of those factors playing out at the same time. And then of course in 1998 we had the Asian crisis and you know the currency bubbles and things of that kind. Again, economic growth was anemic, and in that kind of an environment we clearly saw consumers, pharma and technology companies really kind of outperform by leaps and bounds.
This theme will continue for another 2 or 3 years, or there would be a turning point, there would be a snapping point?
It looks that at least for the next 12 to 18 months, this pack should continue to outperform. And that's because I think the other side of the market, which is the conventional infrastructure, the commodities, the materials, the contracting companies, I think it's going to still take a little bit of time for growth to come back. And when I say growth, profitable growth, I still believe that a few of them still have skeletons in the cupboard. They're still living with the baggage of the past. They're still executing past orders. They still have to receive a lot of money from their customers for whom they have executed projects. So I clearly believe that it's still going to take a few more quarters before profitable growth comes back to them. And you would clearly see, of course, trading rallies in these sectors. It's not that you will not make money. You could see trading rallies in them. But I'd still see that it would be very trigger driven. It would be still very event driven. That if you see rate cut happening, you could see actually a 10-20% spike in their stock prices of that. or if you see them getting some order, you could see an uptick. But I still believe that for the next 12 to 18 months, the bull market which has been there in some of those other sectors, I still believe that has still some more room to go up.
So let's go beyond 12 to 18 months. On a 3 to 5 year basis, do you think L&T will make more money or HUL will make more money?
I'd probably think HUL will make more money, despite the fact that valuations of HUL are on the higher side.
Sure? I mean, that's a big call.
Yes, I think so, because if you really look at it thematically, globally, you never see contracting companies being wealth creators. Okay, you look at the US markets, you look at the European markets, you look at the Japanese markets, you really never see them. Actually, it's typically, it's not the contracting companies which make wealth. So I'd probably say that if you were to kind of look at capital goods as a sector, capital goods, infrastructure, engineering, I think it's the pure play product companies within that, companies which have technology, companies which have components, companies which have products, who could actually end up being bigger wealth creators than just pure play contracting companies or EPC companies.
Give me an example.
So for example, I mean, if the bet would be that I think L&T and HUL may not be a fair comparison, but maybe say if you were to compare L&T with say a Siemens, with an ABB, with a Thermax, okay, I'd probably think that the Siemens, the ABBs, the Thermax, etc. would be in a position to create more wealth than L&T. If we have, of course, if we are in a bull market, even L&T will give returns. But I'm not too sure whether it will be able to outperform the pack of Siemens, ABB, Thermax. These are the kind of companies which have unique capabilities, unique technological strengths, where their products and the services have some bit of pricing power. Whereas what will happen in the case of L&T, the kind of segments it will inevitably see competition come in.
SBI and HDFC Bank. On a 3-year basis, on a 5-year basis, will SBI make more money or HDFC Bank make more money?
I think over a 5-year basis, there's a good chance of SBI making more money. I think on a 5-year basis. The reason being is because finally, both are offering virtually the same set of services. And I think clearly for SBI to do better, it will still be very, very contingent on the kind of reforms which the government implements, which means managerial autonomy, revamping boards, risk management. And then on top of that, if SBI can imbibe technology, okay, and connect with customers and offer better services, then I think the scope for a re-rating in SBI or in public sector banks could be tremendous. But for that, one will have to take that leap of faith that the government will usher in an era of reforms as far as public sector banks go. And I think it's inevitable. It's inevitable for the economy. If the economy has to sustain high growth rates, we need a very solid and a vibrant banking sector. And yet, if you really look at it, the share of public sector banks in the total banking is still disproportionate. So there is no choice. I think it's inevitable for reforms to usher in the public sector banks. So I'd probably think that maybe still for the next 1 or 2 years, it's quite possible that HDFC Bank can continue to outperform. But maybe over the longer terms, if reforms happen, maybe public sector banks have a better chance of outperforming versus the private sector banks.
Now, in the portfolios you manage, you don't have L&T, HUL, SBI or HDFC Bank. So walk us through your portfolio. What's the thinking right now? How are you investing? Where are you shopping?
We still continue to be very biased towards consumer and technology companies. I think
they both are expensive.
They both are expensive, but we also see pockets of value in both the consumer as well as in the technology space, where you still kind of, instead of buying a fresh companies trading at 40, 50, 60 times, we still see some of our companies trading at about between that 15 to 25 PE band, and it really depends on what your definition of consumer is or what the definition of technology is. But I think broadly, if you look at these two as very large pockets, and within that you will have subcategories called consumer discretionary, consumer non-discretionary, and in technology you could have products, services, all of that. Still see, we still see pockets of opportunities there, and we still believe that these are companies which are still doing very well. They basically still qualify and meet all those ingredients that you see for wealth creation, value creation. and we still therefore continue to own them. We still continue to kind of like these sectors, and we'll still look out for opportunities within these sectors.
As a value investor, you typically always look at margin of safety. And my follow-up question is that is the margin of safety really missing in some of the IT and consumer names? The companies which you like are trading at P multiples which are north of 20. The consumer companies you like, their P multiples are slightly stretched and they are again north of 25.
I probably believe that this market is also about delta in earnings, the whole shift in earnings. This market essentially are a slave of profitable growth. And I think what is going to be positive for consumer companies over the next 1 to 2 years is this whole crash of commodities.
Okay.
The crash in raw material prices really expands their gross margins. It gives them more money to further invest in their brands, to launch new products, give a better deal to consumers, and in the process make better margins and better cash flows. Similarly, in the technology space, if you really look at, on the infrastructure engineering times, on trailing earnings, a lot of companies are trading at 30, 40, 50 times. But if you really come to the technology pack, they are still trading at that 18, 20 times, which is in line with the Sensex P multiples.
Do you still like Persistent?
We continue to like it. I mean, we've been owning it now for years.
3 years, I guess.
Yes, it's been 3 years, and I think it's done well. It has a very differentiated business model. It is not into the conventional application maintenance and development work. It is into outsourced product development services. And then, of course, it has an IP-led strategy where it partners with some of the leading technology companies to create new products, as well as is now engaged into enterprise digital transformation, which means it helps enterprises to basically get the digital strategy right. It gives them an offering which is beyond modernization of their technology and is more about digital transformation, which helps them to do business better and in a more efficient manner. And I think therefore it has a very differentiated business model. It's been able to grow at a rate which is better or faster or higher than the industry growth rate. It's been able to relatively hold on margins and has a non-linear model in place. So we continue to like it, and we still think that maybe, yes, in the short term, it's done so well, so maybe in the short term it might underperform. But I think over the next 1, 2, 3 years, I still think it has a business model which is highly relevant and can be very value accretive.
So are you happy to own Persistent for next 3 to 5 years?
Well, at this stage, yes. I mean, we don't see anything better as yet. What we are clearly now seeing also is that a few product companies coming in and getting listed.
A lot of them actually.
Exactly. So there are demergers happening, corporate events are happening because of which product companies are getting separately listed and things of that kind. So we are evaluating, of course, those companies. As of now, those companies do not make profits. So that is a huge challenge for us as value investors, that how do you take calls on companies which do not make profit.
Talking about consumer names, what is your big bet there? Have you shopped anything? Have you acquired anything new of late?
Well, what we continue to like, I think in that, of course, we own several names, but I still believe that we own a company called Zydus Wellness. We still continue to like it. And we clearly believe that they've gone through a consolidation phase. They have revamped distribution, and we believe that over the next several years, all this will even continue to play out. As a stock, of course, it's been doing reasonably well, and we clearly believe that it's a high margin focused company, and we think that that is a good enough strategy. Unlike a lot of the paint companies or the tiles manufacturing, it does not trade at the 40, 50, 60p multiples. It's far more reasonable versus the rest of the pack, so we continue to kind of like that.
Any new acquisition?
I think I'm not too sure whether this has been discussed, but we like the print media space.
Okay.
It's a bit paradoxical.
We've not discussed this much.
Yes. So on one hand, we talk about digital, and it's very commonsensical to assume that who's going to be reading newspapers. But there's some amazing piece of data which says that in the last 5 to 7 years, advertising revenues for the print guys is virtually grown at the same pace as the advertising revenues for the electronic guys. So print is still indispensable. Yeah, people still read newspapers. More importantly, people still advertise in newspapers.
Right.
And we think that what could play out over the next 2 to 3 years, on one hand, is if the economic growth gets better, from 4.5%-5%, we get into 6.5%, we think advertising revenues will grow at even a faster pace, which brings in operating leverage for all the print companies, number one. Number two, newsprint prices are crashing, which means lower raw material costs, therefore better margins. Third, the sector's through with consolidation. Who's launching a newspaper? There's nobody launching a newspaper. So there is a club of 2, 3, 4 players who really calls the shots. And I think, therefore, this sector has already had its share of consolidation, and now it's basically left to the incumbents to really make the most of the opportunity. And valuations are still reasonable. So we clearly like this space. We clearly believe there is value over the medium term. Quite sure that it could be, this whole phenomena could be very disruptive 10, 15 years down the line, where people don't read newspapers, but that's 10, 15, 20 years away.
That's the next generation, not our generation.
Exactly, but I think here for the next few years, I think there's an opportunity.
It is still time to invest into equities, and the big pillars of this bull market are still the 4 big pillars: consumer, IT, to a large extent pharma names, and private banking.
Absolutely, and I think clearly, and then wherever you get that window of opportunity in some of the quality capital goods names, I think that's probably the time to even, start looking at them as well.
Nilesh, this time we've got some Twitter questions for you. So our first Twitter question is coming up on the screen, and that is from Manmohan Mehta. Nilesh, what Mr. Mehta wants to know is that what is the biggest risk for this market?
I'd probably think 2 things. One is, and I'd probably think both are global risks. One is what the US Fed does in terms of the rate tightening. It's not about whether it will or not, but when it does and to what extent it does. And I think the collateral damage that this can create for emerging markets, it can be short-lived, but nevertheless, it could be very impactful. So I think that's one. The second is this whole competitive currency depreciation or devaluation. I think that's the other big risk, where you've clearly seen the currencies of a lot of emerging markets depreciate significantly. And I think for 2015, according to me, that is even a bigger risk.
Okay.
Obviously, finally, it will benefit exporters, but it will create a lot of turmoil in the marketplace before the dust settles. So I clearly believe that these are the 2 big risks.
One more Twitter question. And if rates come down, what will happen to NIMs? And how is India different?
I don't believe the banking sector is in a bubble. Clearly, I think it's one of the best regulated places. We have some outstanding banking institutions which are there. I believe the best is yet to come. If you look at the other side of banking, which is the public sector banking space, if reforms do happen, that space can get even bigger. And if the economy finally has to sustain, 6 to 7% growth rate in real terms, and maybe 10 to 12% in nominal terms, clearly India needs a very vibrant banking sector. So I don't believe that the overall banking sector is in any kind of a bubble. If at all, the best is perhaps yet to come for the sector.
What about your disclosures, Nilesh, before we wrap the show?
Yeah, so I think all the individual positions that we mentioned, we own companies like Zydus Wellness, Persistent, and some of the other names that we discussed in the print media space. So fair to say that we have a vested interest in all the names that I have mentioned.
But you don't own SBI, HUL, HDFC Bank?
Well, we look at very niche-oriented companies. We really don't look at the mega caps on a very active basis unless it's a very special situation. We're more focused on identifying companies which have their respective niches, like to master those niches and then grow profitability and create wealth for investors.
Good luck for 2015, and I certainly hope to see much more of you going forward.
Thank you, Nikunj. Thank you so much.
That's it on this edition of Market Makers. Thank you for tuning in, and have a great week.
Find us on Facebook at facebook.com/ETNow, and don't forget to click the like button. You can also follow us on Twitter at ETNowLive. To stay updated with all our programming, hit the subscribe button on our YouTube channel by logging on to youtube.com/user/ETNow.